They say history doesn't repeat itself exactly. But when the same fundamental pattern plays out again and again for 3 centuries straight, we stop calling it coincidence. And we start calling it a clock that doesn't mark seconds or minutes, a clock that doesn't care about politics or promises or policies, a clock that systematically marks the rise and fall of housing markets every 18 years with disturbing precision. Cut to aerial shots of 1954, 1972, 1990, 2008. Each one a year the world thought was different, exceptional, unprecedented. Each one a year the cycle reset itself, clean, violent, unforgiving. Now the numbers turn again. Cut to black. This is not a prediction based on hope. This is not speculation driven by fear. This is the same mathematical pattern that has shaped land values, credit availability, and financial crises every time civilization convinces itself it has finally outsmarted the past. Tonight, we systematically investigate the one theory that has quietly explained all of it, the one economist who saw it before anyone else believed it, and the specific warning he issued for 2026. Not a warning of total collapse, but a warning of reckoning. A warning that the mathematics of human behavior in property markets follows patterns that transcend individual circumstances. Fade in slowly. Shelves of old economic textbooks. Dust settling. Silence. For more than a century, economists have tried desperately to understand why housing markets rise predictably, why they fall dramatically, and why these movements feel both chaotic and eerily predictable simultaneously. The answers were never truly hidden from view. They were simply systematically ignored, because the math was uncomfortable, because accepting the pattern meant accepting that we have less control than we believe. Enter a British economist named Fred Harrison, an analyst whose predictive accuracy would eventually become an academic embarrassment for every expert who publicly mocked him. In the mid-1990s, Harrison published a claim so specific, so seemingly outrageous, that nearly everyone in mainstream economics dismissed him as a crank. He wrote with absolute certainty, the next major global housing collapse will begin in 2007. Not sometime vaguely in the 2000s. Not toward the end of the decade. He wrote 2007 specifically, 10 full years before it actually happened. When the crash arrived exactly on schedule in 2007, precisely as Harrison predicted, the world chalked it up to luck or coincidence. But Harrison wasn't lucky. He was measuring something the rest of the economic world refused to measure or acknowledge, a cycle that had repeated consistently for over 300 years, across empires, across continents, across radically different political systems, a cycle driven by land scarcity, credit expansion, speculation behavior, government reaction patterns, and the predictable psychology of human greed and fear. But the part that genuinely terrified mainstream economists wasn't the theory itself, it was the calendar. Every major real estate-driven crisis occurred roughly 18 years apart, with remarkable consistency. And now, the mathematics are simple and unavoidable. 2008 plus 18 equals 2026. The math is brutally simple. The implications are not simple at all. But here's the part almost no one talks about in public discourse. These crashes never arrive suddenly without warning. They approach slowly, silently, methodically through warning signs that consistently appear 2 to 3 years before the peak. Just like tremors before an earthquake. And the signs Harrison warned us about, the exact specific signs, have already begun appearing in approximately half of the U.S. housing market. Fade in gradually. Suburban streets, empty open houses, price-reduced banners flapping. Before understanding what 2026 might bring, you must understand the psychology of every real estate cycle throughout history. The 18-year cycle doesn't fundamentally revolve around interest rates, inflation, or political policy changes. Those are surface variables, symptoms rather than causes. The real engine is far more primitive and unchanging. Human emotion, fear and greed operating in predictable waves. The cycle can be systematically divided into 4 predictable phases that repeat consistently. Recovery, years 1 through 7. This is the quiet rebuilding phase following a crash. 2009 through 2015 in our current cycle. People are cautious. Builders are cautious. Supply remains tight. Prices rise slowly and steadily. Expansion, years 8 through 14. Confidence gradually returns to the market. Banks loosen credit standards. Developers build aggressively. Speculation begins emerging. 2016 through 2023 in our timeline. Euphoria, years 15 through 16. This is where the real danger begins building. Prices surge beyond economic fundamentals. People stop asking, is this affordable relative to incomes? And start asking, how much more will it rise? We are entering this stage now. Decline, years 17 through 18. The cycle doesn't end gently or gradually. It ends with a fracture triggered by oversupply, strained buyers, and credit tightening. Every crash looks superficially different on the surface, but underneath, the mechanism is identical, every single time throughout history. Cut to graphs aligning 1970s, 1990, 2008, 2026. The emotional arc is the same. The timing is the same. The consequences are fundamentally the same. But what makes the 2026 cycle uniquely dangerous compared to previous cycles is that unlike 2008, this crisis isn't primarily fueled by reckless subprime lending. It's fueled by something deeper, something more systemic, something no central bank can fix with monetary policy. Fade in, long-shot neighborhoods for sale signs multiplying, inactive open houses, quiet streets. If the 18-year cycle theory is empirically valid, then the most pressing question is, where are we now in the cycle? Not if it will happen, but when. Because the mechanics of collapse don't wait politely, they build invisibly beneath the surface. Let's examine the U.S. housing market in 2025 with cold objectivity. The data is absolutely clear for those willing to see it. Active listings rose 17% year over year in September 2025, marking the 23rd consecutive month of growth in inventory. At the same time, national inventory remains 13.9% below pre-pandemic norms, signaling there's still substantial room for supply to expand further. In multiple states, inventory has already exceeded pre-pandemic levels completely. 17 states were above their pre-2019 inventory benchmarks by late 2025. The strain on buyers is real and measurable. A surge in listings, dramatically longer times on market, median days rising to 62. Homes that once sold in weeks now sit for months. Analysts at the highest institutional levels are flagging trouble. For example, the outlook published by J.P. Morgan Chase in early 2025 projected housing growth of 3% or less for the year. These metrics are not isolated anomalies. They map exactly to the early warning phase of past cycles. In the language of the cycle, years 1 through 7 represent recovery, low risk. Years 8 through 14 represent expansion, rising risk. We are now in years 13 through 14. Peak risk is approaching rapidly. And here's a second, often overlooked dynamic, regional variation. Some U.S. markets are already showing flat or declining prices while others continue modest gains. When some markets fall but the national average hides it, the structural risk is already present and growing. The cycle doesn't wait for consensus or permission. It doesn't ask if we're ready. It builds pressure until the system is fragile, and the slightest shock triggers the collapse. Cut to archive footage of 2008, banks collapsing, houses foreclosed, families displaced. Every cycle is unique in its details, but the fundamentals have common elements. In 2008, it was subprime lending, derivatives, financial institutions collapsing. In 2026, the trigger may differ superficially, but the underlying risk is no less real. Let's examine two potent differences this time. Elevated price-to-income ratios. Elevated systemic risk. Global economist Fred Harrison has long argued that the real tipping point for housing is land value, not just credit availability. His cycle theory shows a bottom-to-peak duration of roughly 14 years. We are now at year 14 since 2008. Harrison predicts a peak around 2026, followed by a correction or crash. Inventory and affordability strain. The U.S. is facing a rare imbalance. Inventory is rising rapidly even while supply remains structurally constrained. For example, land use restrictions. First-time buyer participation is falling, and affordability is eroding. For context, some reports show first-time buyers share near historic lows. Inventory growth of 17% hides the fact that homes are sitting longer, price cuts are more frequent, and buyer leverage is shifting. Put both factors together, and you get heightened systemic fragility, affordability issues, buyer pullback, rising inventory. These are the classic preconditions of the crash phase. And because housing is simultaneously both a consumption good and an investment asset, the feedback loops amplify. When prices stall or drop, consumer confidence falls, spending falls, employment falls, housing demand falls, further price pressure. This time we are entering the collapse stage of the cycle, with elevated valuations, elevated debt burdens, longer duration of supply increases, and historically low margins for error. The outcome, when the drop comes, it may be steeper, faster, and more widespread than previous cycles. From this point forward, there are only two possible futures for the U.S. housing market: the optimistic one and the catastrophic one. Every choice you make in the next 18 to 24 months depends on knowing which road your local market is standing on right now. Let's examine both futures with brutal clarity. Future A, the controlled cool-down. This is the version most institutional forecasters prefer. Economists at Fannie Mae, the MBA, and major banks project modest growth through 2026. A gentle landing. A soft correction. Prices flatten. Maybe rise 1 to 3% annually. Rates fall slowly. Inventory builds but doesn't overwhelm. A cooling, not a collapse. If this scenario becomes reality, the biggest threat you face is waiting. Because in a controlled cool-down, prices don't fall enough to compensate for rising rent, time lost, and compounding inflation. Buyers who wait lose affordability permanently. Sellers who delay miss the peak. Investors find shrinking yields. This is the path where indecision costs more than action. Future B, the cycle hits hard. This is the world Fred Harrison, economic historians, and cycle theorists are warning about, and the early markers are already lining up. Inventory rising for nearly 2 consecutive years. First-time buyers shrinking. Price cuts becoming the norm in dozens of metros. Months of supply trending upward. Housing to GDP ratios reaching bubble-era ranges. Regional cracks spreading like fractures in a frozen lake. In this future, 2026 is the peak. 2027 is the correction. And the people who position themselves now become the next generation of wealth builders. This is the world where cash is king, where distressed assets return, where investors who were laughed at in 2025 become geniuses in hindsight by 2028. This is not fear-mongering. It's the same reality that reshaped wealth in 1990, the same that rewired the market in 2008, the same cycle repeating for over 300 years. The truth is uncomfortable, but empowering. We don't need perfect prediction. We only need positioning. You don't win cycles by timing the exact moment the wave hits. You win by preparing while the water is pulling back. And right now the water is pulling back in plain sight.